This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the continued support and for tuning in. If you like what you hear on the Planet MicroCap podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps more folks discover the show and join the MicroCap investing community. We announced our full slate of investor conferences for 2026, all in partnership with MicroCapClub. Our next major event is Planet MicroCap Las Vegas, happening June 16 through 18, 2026 at the Bellagio. Registration is now open for that, and later in the year, we'll be heading back to Toronto, October 27th through 29, 2026 at the Arcadian Loft. The mission is to bring the best microcap investors and companies together to gather, connect, and grow. This includes your participation. We know you're putting your 2026 travel, conference, calendars, everything together right now, and we'd like to humbly invite you to join us for one or both of these events. Please visit planetmicrocapshowcase.com for more information, and I'll see you in Vegas and Toronto. Now, my guest on the show today is Dylan Marrello. He's the founder and portfolio manager at Marrello Capital. In this episode, we take a deep dive into D-Box Technologies. It's a publicly traded company. The symbol is DBO on the TSX. It's a haptic technology company that's been discussed quite a bit recently. Now, the movie theater industry has been through a dramatic reset over the past few years, from streaming pressure and COVID shutdowns to consolidation, higher ticket prices, and a renewed focus on premium in-theater experiences that audiences simply can't replicate at home. As the industry recovers, exhibitors and studios alike are leaning into technologies that enhance engagement, drive higher ticket spend, and improve their theater economics. We discussed D-Box's shift to a high-margin theatrical royalty model, the impact of new management, strong insider alignment, and how premium experiential formats are reshaping the future of movie-going. For full disclosure, we mentioned a number of names in today's episode, including D-Box, and I am not a shareholder in any of them. So thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Dylan Marrello. Dylan? Good to see you, man. How you doing?
What's going on, man? It's good to see you. Thanks for having me back on.
Hell yeah, dude. It's great to see you. Happy holidays. We're recording this on December 16th, so if it comes out, whatever. Happy holidays, man. Everything. What's going on, man? It's been since Vegas since I saw you. Everything good?
Yeah, it's been since April. Yeah, we were just talking before we started recording that, things in the market have really changed since then, because that was a particularly brutal period, like right after the tariffs or kind of during the tariffs, right?
That was so fun.
Yeah.
Like literally our event being 3 weeks after, what was it, Freedom Day or something like that?
Liberation Day.
All our Canadian friends just being like, yeah, Bob, like we want to come.
Yeah. Honestly, it really ended up being a really fruitful experience because, in addition to meeting everyone, like there was a couple presenters there that I ended up investing in that have really helped propel the year a bit. So
I just had I just had Paul Serro on, and we were reflecting a little bit about I can't remember if it was the Wednesday. I think it was the Wednesday night where we all went out and just that was the best time. It's just we just ended up sitting there for like 2-3 hours, just talking about every company and what you guys thought was interesting and stuff. That was I mean, that's why you do this stuff. It's so much fun.
Yeah, and a lot of those companies have actually performed really well since then. Like I haven't followed all of them, but like the ones I do have generally done quite well. So it was,
I've only followed the ones that I think are doing really well. The ones that aren't, I don't know. What are you talking about? There's ones that haven't performed since then. What do you mean?
I think it's a pretty good batting average, though. I think. Yeah, I haven't followed them all, but yeah,
for sure, we'll take it, man. Well, hey, listen. The main reason I invited you on here today is because listen, there's a whole bunch of investors that I respect out there that have been talking up one name in particular, that being D-Box. I had the company on a couple years ago, or not a couple years ago, my bad. I guess it was February 24 with previous management on the due diligence pod. So, it was a pretty much almost a completely different, not completely different, but the thesis was not what it is today. But even before we
Story's
get in,
really changed. Yeah.
yeah, but before we even get into all that, real quick, just catch us up. For those that don't know you, give a little bit background on Marrello, and also maybe how performance has been thus far this year.
Sure. Yeah. So I think probably some of your listeners know, but I was an attorney before. I was a commercial litigator, and then sort of started the Substack and Twitter kind of a few years ago, and took off pretty quickly, doing some investment research, and then this year I started my fund. Kind of second week of January was when we launched. And it was, as I was saying before we started recording, like pretty tough start. It's a concentrated fund, long only, small cap value, and that stuff just got kind of eviscerated in the first couple of months. And then, it's crazy how quickly things changed, right? So it's ended up being quite a good year so far, almost at the finish line. But yeah, it's really like, it's crazy in this business how quickly things can change, right? So like on the lows, you got to stay confident. On the highs, you like can't get too much hubris, right? Because literally, like within a couple of weeks, the entire thing can just turn around on you. But yeah, it's gone pretty well, and looking forward to being a little bit more public with it and scaling it now that we're sort of through the first year. Because kind of intention with the first year, as I was saying, is like marketing is kind of useless if you have a bad year. And the performance sort of speaks for itself if you have a good one. So kind of kept my head down and didn't talk about it too much in year one, but things have gone pretty well. And D-Box is obviously, which is actually now grown, excuse me, into the fund's biggest position. So it's really helped, and it's kind of unusual. I don't think I've ever done this before, actually, like pitching something that's up 500% in a year as a long, right? And saying it's still interesting, but I think because of how dislocated this was, that it's actually it's still super interesting. So we're holding the shares, and it's like right now about a 15% position, 16%.
Very cool. Well, yeah. I'll start off by saying, full disclosure, I'm not a shareholder in D-Box. Like I said, I interviewed them, former management, back in February, March 24. So love to get the full picture, with what's going on there with this one. I mean, I don't normally do like the individual stuff, but like there's just been way too much chatter about it that I'm like, all right, we might as well let's do this. So I mean, from your perspective, love to hear the process of idea generation, how you came to it, and then what how you put your thesis together around it.
Yeah, for sure. So, one of the things that I spend time on is, kind of investing in capital cycles. So looking for industries that have gone through some kind of trauma, whether it's like competitive dynamics or, in this case, it was, I started focusing on movie theaters kind of late 2024, early 2025. And the reason for that is because obviously probably no industry that's gone through a harder time in the last decade. They had generally the headwind of streaming becoming ubiquitous, but then, that kind of really hit the culmination when literally all the movie theaters closed down during COVID, right? And these are really high operating leverage businesses. Like, the biggest part of the expense line is leases, right? So they kind of lose top line and you're still paying those costs. It's a catastrophe. So a lot of these businesses, like famously AMC, got super levered up. AMC became a meme stock, but a lot of these companies filed. And I like looking for these situations where it's like you have capital exiting the industry, because as that industry kind of consolidates, and the strongest players are the ones that tend to survive, you get a less competitive backdrop, returns improve, right? So kind of start looking at the operators. There's not that many publicly traded ones left, and kind of notice, okay, there's a bit of a rebound right now in the box office. So it's kind of like the goal is to get to 80% of the box office of 2019, and we're sort of pushing up pretty close to that now. Attendance is way down, But the reason they've been able to kind of get their top line back is largely through pricing increases. So, theaters tend to have pretty good pricing power. Over the last 20 years, basically, movie theaters increase their prices every year. And that probably goes back even further, right? So that's sort of been helped by the lack of competition. But as I'm kind of looking through all these operators, one thing I notice is they're really pushing a premium experience because, and you've sort of seen this throughout the history of movie theaters, but basically what generally happens is some new technology comes out, like the TV or the VCR, and it changes people's relationship to cinema because now it's content is more accessible at home, right? And historically, what's happened is the theaters respond by upgrading the experience. So, there was this sort of megaplex thing that rolled out in the 90s. And now the premium format is, most famously IMAX, right? So what they've done is, they structure these things where it's a premium ticket, and the tech provider gets some share of ticket sales, but they actually draw crowds because I don't know if you've been in an IMAX recently, but like the kind of new IMAX auditoriums are actually super impressive. So kind of look at like Cineplex, for example. They've been advertising that it's in the 40% of their ticket sales now are premium, or at least that's premium revenues. So that kind of brings me to D-Box, which is a premium tech provider. And, these companies in the broader ecosystem are capturing a huge amount of the value. So you can sort of see IMAX is trading at like 30 times earnings right now, almost 25, 30 times. And it's a $2 billion enterprise value or so. And despite that, like relatively, low share of assets in the industry, they're extracting a huge amount of value. So that's like a good sign that there's something going on there, right? And the reason they're able to do that is because studios need theatrical windows to market their films and make money on those productions. And exhibitors, if they want people to come, need to have the technology. So like these tech companies are sitting kind of like, they're like the crux of the entire ecosystem, and they're extracting economic rents. So, this is where D-Box comes in. So D-Box is a haptic technology company. Basically, the experience is you buy a D-Box ticket, and they have these, they put actuators. So it's like hardware that goes into a seat in an auditorium. And there's a software component to it. So there's, they program, specifically for an individual film, like a choreographed motion experience. So you're sitting in the theater and the chair kind of moves with the haptic technology. It sort of sounds ridiculous at first. But if you try it, you're like, this is actually kind of cool. And there's like a pretty big and growing audience for this kind of thing, right? So D-Box, unlike IMAX, is it's a lower capital expenditure for the theaters. You don't have to refurbish the whole thing. It's usually just like a couple rows in like the back 2/3 of the theater that have D-Box seats installed. And the way they make money, this is just their theatrical business. They do have other segments, but I personally, this is the most interesting part of the business by far. The way they monetize this is a hardware sale, which is like roughly 30% gross margin, and then a royalty off of ticket sales. We can kind of get into what's changed, but like basically, due to demand from exhibitors, the system installation has grown rapidly. And at the same time, the box office is picking up speed. So there's higher ticket sales, which means more royalties on a larger installed base, and those royalties are basically 100% margin. So they have been able to, kind of start scaling and generating tons of cash, and their margins are exploding. And kind of look at the white space, and it's enormous, and we can get into that, but like they largely, at least in North America, are rolled out in Cineplex, which is like basically a monopoly in Canada, and then Cinemark, which has the third largest share in the US. They also have they have screens in Australia and other parts of the world too. But roughly the screen count right now, I think it's about like 1,100, little over 1,000. So the white space here is huge. And the demand both from the end user and the exhibitors is growing. And as the industry recovers more from COVID and balance sheets improve, I think it's going to enable more of the operators to start installing D-Box, recognizing the success they like Cinemark and Cineplex, for example, have had.
All right, so that is a great start to this and kind of the formulating the thesis and whatnot. And it actually, now that you're saying it aloud, not that much has really changed in it's pretty much. I mean, like I remember talking to a former CEO, and it was pretty much at that time it was more of an execution risk of like, okay, here we got it. Now it's just a matter of getting more theaters on board, getting more screens.
That's certainly part of it. Things have changed. One is that there's a revenue inflection, as you know, just by expanding this system installation count, right? But there's been really meaningful change on the cost structure. So, and this was kind of the problem, and get into this, there was an activist, he's still on the board, Daniel Marks, and he basically, the stock was in the total gutter. And the reason for that was, you had this sort of royalty-like business that just could not generate any profit for decades, right? What was happening is basically they were focused more on the business as like a hardware business and then going into a bunch of different verticals, right? Not just theatrical. And so you had pretty high operating expenses that were basically just eating, all of the revenue. So you've sort of had two things going on at once. One is you've had inflecting royalties, but you've also had a much more disciplined cost structure. Like this is being run now as a royalty business with the, principal intention of building out the theatrical business. So they've discontinued some of their offerings. Like they have a sim segment as well, like simulation racing. But the main part of this thesis, and the thing that I really focus on is the theaters. So you've had an industry rebound, growth in install counts, and, basically an entire turnover of the management team. This is what's pretty interesting because even since I've been involved with the company, probably started buying stock not too long after I saw you in Vegas in April. So, late April, May kind of thing. And even since then, there's been more turnover, right? The new CEO, new CFO. And as you kind of study what's gone, like kind of the history, you sort of realize this is the first time that you have what appears to be total alignment from the C-suite and what they want to do here. And because of because of the way they focused on this and growing out the unit count, you get really, really crazy operating leverage, right? So you went from basically nothing to 20+% margins, and those will continue growing. So it was kind of like a refocusing on how they wanted to position themselves. There's obviously been a lot of multiple expansions. So kind of just say right now, I think shares were around 20 cents earlier in the year, and they're in the 90s now. At today's share price, the market cap's a little over, it's roughly 220 million Canadian. So still a small company. They did 4.5 million of net income last quarter. Right. So I think that's roughly 1/3, maybe a quarter of the market cap of the business, 8 months ago. So there's been an enormous inflection. And you kind of if you sort of asked me to, paint a picture of the ideal investment, obviously hindsight's 2020, but this really ticked all the boxes. It's happened faster than I expected in terms of how quickly they've rolled out system installations, but I also think that's evidence of a more focused management team now, right? Like the fact that this wasn't scaling that quickly, given how clearly lucrative it is, for the entire ecosystem, is kind of surprising.
Well, not to cut you off, but I mean, let's play devil's advocate a little bit, because I would think, okay, the bounce back in theaters, that was all, I think most people expected it to come, but it's also very dependent on the films that come out that year, right?
Push back on that a bit. Like, I don't think anyone really expected that. Like, like people just hate this sector because it's not only the post-COVID world, but like people have been predicting the demise of movie theaters for decades.
And there's still a chance right now. I mean, that was actually going to be one of my questions.
Always.
With the Warner's Netflix thing, and now,
there's always something, right?
Yeah, for sure.
There's always something, but you did say something which I will agree with, which is that it's content driven, right? So I sort of described it as there's a bunch of different cycles in this industry. There's a capital cycle. There's also a technology cycle, which I kind of touched on when I said, they'll innovate some new way to get people to come to the theaters after there's some kind of like tech revolution that makes viewing easier at home. So there's like this tech cycle, but there's also a content cycle. You have basically, in the sort of late 2010s, you had this sort of like monopolization of like IP from like Disney, which was just basically like Marvel movie after Marvel movie after Marvel movie. And they were like big hits, but they basically cannibalized like the rest of the industry. Like there was nothing else, and people got tired of that. And what's sort of happened now, and why the industry has, I think, structurally changed, it is in decline in some ways. There's no denying that, right? But a lot of that's offset by price. But one way in which it has changed is like the number of films being released. So the box office today is much more hit driven. It's like blockbuster driven, right? So you used to have, there was a time in the 90s, like the sort of Miramax days of like, Pulp Fiction, for example, where like a lot of independent films could fill auditoriums. And so you kind of had this consistent flow of attendance. Now what happens is you have, something like Zootopia, which has been like a huge hit this year. And then, you get $1 billion of box office sales, and then there's just nothing for 2 months, right? So you have there's a lot more holes across a like annual release schedule. But if you make the right film, the appetite is as strong as it's ever been. So you kind of needed to look. And one of the nice things about this industry is you do have like you have a couple of years of visibility into what's coming out, right? So you can sort of see up to 2027, but there's a bunch of blockbusters on the way.
So I mean, I guess my main thing, I'm curious from your perspective on your thesis then, is it a bet on the tech, or is it more of a bet on the bullishness of, the right content now, the content flow, there's the kind of the cycle being somewhat back or growing on people going to the theater?
Yeah, so I'd say both, but it's not, you don't really, in the case of D-Box, I actually don't think you need to underwrite much growth in the box office at this point. Mm-hmm. You do need it to be, somewhere where we are now, but I think that's reasonable. We've sort of like, since 2023 sort of been at the same level. Next year, they expect 10% growth, which I think is probably going to pan out because you do have like a lot of big releases. But the reason I say it's not that important is, there's 3 things really going on that are growth drivers for D-Box specifically, right? So one is just under penetration of global screen count. So even if you have somewhat of a flat box office line, they're adding systems really quickly, right? So you just have more seats earning royalties. So that's one thing, right? Number 2 is a mix shift towards premium, which I kind of highlighted, but you're increasingly, I think you're going to see D-Box over-indexing to the box office, right? And you can see this with IMAX, like on steroids, but I'll get the numbers wrong. But IMAX, yeah, I think I have an investment in IMAX's Chinese subsidiary, and I think it's like something like 1% of screens there, but it's 6% of the market share. So you have this over-indexing going on towards premium, which again helps to offset like lack of growth from like the total box office. Number three, which is like sort of not quite an in the money thing yet, but I think it will get there, which is an increased take rate on royalties. So basically, my understanding is that D-Box agreed to a particular, so I think it's $8 a premium for a D-Box ticket. That was set like a decade ago or something. Box office ticket prices have gone up substantially since then, right? So that $8 uplift is a smaller percentage of the total spend. So I think there's room, particularly as, I think the operators are convinced of the value add, for the actual royalty take rate to increase, right? So you have, basically two growth levers that have no incremental cost, right? It's just like pricing, and shift towards D-Box. And then obviously you get the unit expansion, which has like a hardware component and a lower gross margin, but still profitable. And then obviously those add to your potential to generate more royalties. So I don't really think, as long as the box office doesn't disappear, which it won't, at least in the next few years, I don't worry too much about like, getting like underwriting like any material growth there.
Is that also part of your bear thesis though, in a sense of like, all right, they're making a full bet, or at least you're making your full bet on this, really the theatrical business here, and all the opportunity and growth prospects there? Because the main reason I ask is part of my second part of the devil's advocate question was like, all right, I get why they're trying to diversify, because there's so much confusion about where box office is going, content, all these different big blockbusters that's supposed to be monster hits weren't, so okay, they're doing the FIA thing. They're, I don't know, might try and do a video game. Like there's all these other things that the technology could potentially have some kind of commercial opportunity there. So why risk just going all in on theatrical when we can kind of diversify to make sure that we don't get totally screwed?
Yeah, so I guess there's like a few parts to that. I just think on the theatrical side of the equation, I think it's like really punitive to assume that like there's some like really short terminal value on that. And you're not paying so you can kind of get into valuation, but you're not paying much here, right? Like I sort of think like maybe you're at, a low teens multiple on next year's earnings, and that could quickly shrink in the future years. They're like building a ton of cash, and earnings are going to inflect quite a bit as they increase units. But they have the simulation racing business, which is pretty interesting actually, and I do think at its core this is a tech business, and it could be used in other things. And it's sort of an open question as to like what that looks like. Right. But, one of the sort of most important features of this thesis is like, I really think they have like a technology moat. So like, they're very good, like a haptic technology company. Right. And so this is sort of like, there's like the Peter Thiel moats of like, IP, brand, network effects, switching costs, right? Like, they have the IP. It's very valuable. You can do other things with it. I'm sure they're exploring those things. Now you need to be intelligent about how you do it. And so I don't exactly know what that'll look like, but I'm pretty confident there's value in some other markets for this technology. So that's sort of one. I kind of mentioned brand. You can go online and see this, but like there's some people who like totally geek out on D-Box. So I think you can see that there, where it's like, hey, this sort of has like a valuable consumer facing image, that again could sort of be monetized in other places. But yeah, I just think ultimately, given the valuation today, and the market opportunity, right? Like you can sort of talk about saturation, but they are barely scratching the surface of like the addressable market in theaters, right? So even if you had declining revenues at the box office level, one would think if you're an operator of a movie theater business and you start to see your revenue going down, well, how are we going to get that back up, right? And one is like better offering, so more D-box seats, right? So the constraint right now is balance sheets, right? Like, for example, there's no AMC theaters that have D-box because AMC can't afford to install D-box, right? And they have too large of a network to just put like D-box on a couple screens, right? Like if they want to do this, they have to make a substantial investment and they don't have the capital for that. So number two operator, Regal, they emerged from bankruptcy. Like they don't quite have the balance sheet yet. And this is like the fourth, Marcus, like they're basically not with anyone, right? So that's just the North American operators as well, right? Like there's a huge global opportunity. So I think like, that's sort of the key here is, roughly, each 150 screens or so is probably like a couple $1 million drops to the bottom line. So they can like really, the key to to making a lot of money here is just continuing to roll out units across that addressable market. And I sort of expect that to happen. So you can see a lot of these companies have balance sheets that are improving quite a bit. This is why the next couple of years are really important too, right? It's like you do have visibility in the release schedule. And 2026 and 2027 are going to have, I think the operators will generate quite a lot of cash flow, right? And so that cash flow materially improves their balance sheets and puts them in a position to fund the CapEx. And, there's also opportunities to come up with some financing structures, right? So if an operator can't just fund all the CapEx up front, I'm sure there's some pretty clever ways to do a financing structure.
Do they have any data on, like per screen, breakdowns of like, all right, here's how many D-box seats got versus, and is there more uptake in the D-box seats versus just, the normal seats?
Yeah. So I don't think there's an actual breakdown in what like the particular D-box like mixes. But you do see what premium mixes are for a lot of the companies. You can't, like I mentioned earlier, like Cineplex is that. So Cineplex is a huge adopter of D-box. And, you can see on their press releases, they're like 40% plus premium. So that's IMAX, D-box, 80X screens. There's like a few different premium providers. But they are clearly attracting people. That's why they're scaling them so much, right? So you can see in Cinemark's press releases, they're like, basically every time they have a press release, they're like, we have a new record for D-box sales. So, and they're adopting them like crazy, right? Like I think there was 150 added in the last few months. So they're like really aggressively doing this. Cinemark's sort of in the space considered to be the best operators. Like very focused on ROI and like quite conservative. So I think it's a pretty big signal. Generally the way it works at like a specific theater level is you might have like, let's say you have a 10 screen theater, maybe they'll put them in like 5 or something, right? Like they're not going to be in every screen you have at a given theater. But I think it's like an average of 4 or 5, and then
you put in like the bigger theaters where you're probably going to put the bigger movies. That makes sense.
Yeah, and maybe like I think it's 20 something seats, that will just be D-box, right? Like it's just a couple of rows. Another thing to note is that D-box. So IMAX doesn't allow D-box seats because IMAX has its own sort of like proprietary idea of what the whole experience should be like. I've kind of talked about this before, and who knows what will happen, but I sort of think that they would be a really logical buyer of D-box because...
Hit on my next question.
Yeah, so it's like, look, you have all these IMAX is sort of, I mean, you can look at their stock, but they've done it, like, notwithstanding all these headwinds, like the stock has just been a rocket ship recently. And like they're just killing it on all levels. That's sort of the number one format right now for film, understandably so. They have, I think, IMAX has whatever 1,000. Well, it depends on the location. They've got like 800 in China, and we can talk about that too. Like D-Box isn't even in China. So you could fold all these D-Box, all these IMAX auditoriums and have D-Box too. Right? Because what's happening right now is you're competing directly with IMAX, right? Like, so for certain films, like take, for example, Odyssey, so Christopher Nolan's upcoming film, right? Like, I don't think there won't be a D-Box, I don't think, because Nolan is like the biggest fan in the world of IMAX. Like he shoots on IMAX cameras and stuff, right? So like you have this big chunk of the box office this year that'll be for a Nolan movie, and D-Box won't capture any of it. Whereas, for example, last quarter, like you had F1 last quarter, right? That got some IMAX, but also like you can imagine that'd be a pretty cool one to watch in D-Box. So it really is going to be a bit sensitive on like what films are coming out. So D-Box has done like really well in action movies and family movies. Like you take your kids to go watch a movie and like you sit in the moving chairs, like you can imagine your kids would enjoy that, right? So you have a lot of.
I haven't taken my kids to the movies yet. We'll see. I'm already like thinking to myself, like.
Yeah, I think that probably have a blast, right? So it's like, I think
is there an earthquake going on? What's going on?
Yeah,
like no clue.
Yeah. Well, you're definitely very aware of them when you're in them. I've done it a couple times, but yeah, it's like you have a ton of family movies coming out this year. Like Toy Story. You can go on D-Box website and you can like see the upcoming releases, because remember, each film, and this is I think important, to just sort of understand from like a ecosystem perspective, but like each film is choreographed by engineers at D-Box, right? Specific to the film, and then it goes to the studio and they have to sign off on it, right? Like the director has a say in how this is going to be done. So there's a working relationship with the studios. Again, that's another signal that this is valuable service, right? Because why are the studios taking time to do this? Because they can see an uplift in box office receipts.
Well, that also makes sense, because there are certain directors that won't work with certain studios unless they know they're going to get a theatrical release, and so the studios want to make sure that they're working with all the experiential tech to make sure that and then they can present it to them like, hey, by the way, makes total sense. Makes total sense.
Yeah.
So, I guess, I mean, it's interesting you hit on the IMAX point, because I was trying to think to myself, like, well, what does kind of D-Box remind me of, from a larger scale, large cap level? And I guess IMAX it really does, huh?
IMAX, yeah. And I mean, look at the multiple IMAX trades at, right? So this is kind of, so let's say, it's 90. I think it's sold off a little bit today, which is actually nice to see. But I think it's like in the low 90s share price, 92 cents or something. Maybe they do 6 to 7 cents a share in earnings like this year. They have a weird fiscal year, so it ends like March. End of March is their end of their fiscal year. So that's full year. That's fiscal year 26. Maybe like from March to next March, they'll do like 8 cents. Okay, so you're in a low teens earnings multiple versus IMAX, which is like mid to high 20s. You're also growing really fast, right? So if you kind of get to, let's say they do 8 cents a share in a year or two, and you put it at 20x, it's $1.60, and it's 90 now, right? And I think this can get really crazy, and the way that happens is new partnerships with operators, right? Because again, this is just like basically being driven by a handful of players. If you get Regal, who knows about AMC, but maybe they file or something, they have to restructure. The possibilities are pretty wide, right? So I think, I'd be surprised to not see a new partnership announcement pretty soon. All right, and again, like every 150 new screens is another cent of earnings. right? And they're doing 6 now. So it's a really big uplift just for like 150 incremental units. So they grow their screen count by 10%. They grow their earnings by like more than 20.
So in your opinion, I mean, we've talked about some of the risks because I get the bull theory, like you've done a really good job of just hitting the nail on the head there. But in your opinion, where does your thesis break other than execution risk?
Yeah. Well, I guess if unit growth starts to stall out, right? And that again, I think is mostly going to be a function of how the box office performs, right? If you have like a pretty big degradation of where the box office comes in compared to expectations, and right, because there's a lot of operating leverage for the operators. So if you have a slightly bad year, suddenly you're cash flow negative, right? So now your balance sheet's starting to get into trouble, and now you don't have money to expand. So you do need a healthy box office. You don't need like a return to the glory days or much growth, but you do need something. So I think this is why I say like the next 2 years, I'm not that worried. Obviously there's like crazy left tail risks, like another pandemic or something, right? But outside of that, I'm pretty sure people are going to go to the movies for the next couple of years. They have no debt, and it's very cash generative, right? I think they have like maybe 14 million of cash right now. That'll continue to grow. So you don't really have much balance sheet risk. So maybe one of the risks is like they try to enter a new market, they spend a bunch of money on it, and it doesn't work, right? But I think this new management team is not going to do that. And one other thing I'll say, which is it's not really responsive to your question, but it's interesting, is that the insider buying here has been absolutely crazy. And basically sometime in the summer when there was a clear turnover of management, you had a bunch of insider buying kind of in like the 20-30 cent range. But what makes it really interesting is that actually the insiders have kept buying all the way through. So I think the CEO bought some shares last week or the week before at like 85 cents. Like, how often do you see management teams buying their stock after it goes up 400%? Like, it's crazy, right? Like, they're not selling, they're buying. So obviously they're seeing, I think what we're seeing, which is like, you have a very big inflection coming, and they probably sense that there's some partnerships on the way that will really change it. So there's execution risk, there's kind of box office collapse risk, and there's like capital allocation risk. And then obviously anytime you're buying a business with this kind of an economic profile, right, that tends to be, this is not something that's trading at 3 times earnings, right? So there's a little bit of trouble, you could probably get multiple compression, right? And that's sort of what I actually, as much as I theoretically love these sort of like fast, like royalty business models, I tend to avoid them actually, because you're a little bit wrong on how you forecast demand, which is like notoriously difficult to do in most industries.
Especially movies and
multiple compresses, right? You just think you take on a little bit of multiple risk, right? Like it's a teens multiple now. So if the demand kind of forecast doesn't pan out, then maybe you get some multiple compression. And this is kind of what I say, avoid these industries often, or these business models often. But what's again sort of nice about this industry is you do have some good visibility into the slate of content that's coming out. Right. So, a lot of times you get these like med tech stories, for example, where you sort of have a similar thing where it's like you get hardware sales and then you like charge like a per use fee or whatever. Right. I think actually when we were in Vegas, like I think like almost all the stock pitches like involve some business model like that. Right. Like people love this. Problem is like, if you're wrong about the demand, it can be a big problem. But here, what I like is you can see like all these films that are coming out through the end of 2027, and soon we'll have the 2028 visibility. So, there's a reason, like things can happen, but there's a reason that like, I'm up pretty significantly on this position, and and it's, mid-teens percent of the portfolio, and I'm not selling because like I just still think you have a pretty big margin of safety here. And I mentioned like the 4 different kinds of moats, right? So you also have now, you've got this network effect because you now have the studios like committing to, overseeing the process of engineering the films, right? Like making sure the software is right and choreograph for the specific films, right? So get a competitor come in. It's like, well, I'm already doing this like for D-Box, like, it's, so you sort of have, as the network grows, it's more valuable. And then you have switching costs because it's like you already installed all these seats, right? Like if you're Cinemark and Cineplex, you just have all these D-Box seats. You're not really, so I don't really, and the tech is just, I think pretty clearly, the more work you do on this, superior, right? So you don't have much competition risk either. So I mean, I guess one risk is that there's just like, there's fad risk or something, right? And people are like, actually, I don't really like this D-Box stuff that much anymore. I think that's unlikely because like it's still pretty niche, right? It's like it's just a couple rows per auditorium. I think if you go to an auditorium and it's like, hey, they're offering these like haptic motion seats for an extra $8 or whatever, like why not? Right? It's not like it's a specific unique experience. Like I'm going to D-Box. It's like you're just going to the movie and here's like a slightly upgraded way to experience it.
I was also curious about this, in thinking about like, how is it marketed? I mean, I guess they're not installed the Cinepolis in Westlake because I haven't seen it yet when I've been looking at my own movie ticket experiences.
Yeah.
But how is it marketed? Like, how do people know like what even haptic is? I did. The only reason I know what haptic is, I did an interview like 3 years ago or 4 years ago with a wonderful interview about haptic technology and haptic sensory and how that was kind of the next thing in technology. So, like, how do people know?
Yeah. So, I mean, one sort of direct way is if you go buy your ticket online, which a lot of people do now, right? It's like you'll just get presented an option. I think there's obviously a word of mouth kind of dynamic to that, right? Because you're going to be like, what the hell's D-Box when you go to buy the ticket? But the operators advertise because they make more money off of D-Box sales than a regular ticket sale, right? So a lot of that marketing is sort of getting done for you, at the operator level. And as I think there's a lot of like repeats here. There's a bit of like, as I was saying earlier, there's like kind of like a cult online. You can see people talking about it. So I think, kind of word of mouth gets out and then the operators make quite an effort to get you to take that ticket. So like if you buy something on like Cineplex or like Cinemark's website, you get sort of nudged towards like, hey, do you want to like have a premium experience instead? So I think that's largely what happens. And then like from the D-Box level, it's more about like the focus for them, which they do marketing. Like you can like sign up on their website and they like send you newsletter, like a news update all the time. But like, hey, we're doing like this experience, right? Like they like, for the sort of like sim racing stuff, like there's much more of an aspect to that. But I think sort of the key for them is like you get partners to adopt the build out of the technology and then they will do a lot of it for you because like it's in there. And that's again, it's one of the nice pieces to this premium tech provider thesis that sits at the middle of the industry is that like, I don't know what the actual like term of art is for this, but like you have everyone in the value chain aligned with D-Box, right? And this is how you get businesses that earn excess returns on capital, where it's like you have the consumer wants it, the theater owner wants it, and the studio wants it, right? So everyone is sort of aligned on your place within the ecosystem, and that's sometimes unusual, right? Like sometimes it's like a product or a service that like you just need but you don't want it or whatever, right? And like in this case it's like everyone's just like, we have to use this because like we need to sell tickets and people don't want to. Sometimes I talk to people broadly about like the exhibition industry and they're like, I don't want to go to a movie theater, like sticky floors, uncomfortable seats, like expensive food. Like it's over. Like I'm just gonna stay at home, right? So there's this difficult presumption a lot of people have because they haven't gone to the movies probably since before COVID. That like it's just what it used to be, right? And I'm sure you can remember those days. You get like it's literally those sticky floors. The chairs kind of sucked. People are talking, whatever, right?
I'm the worst person to ask because I used to be one of those where, like, my favorite thing to do used to be just like, oh, I get to go to a movie by myself and just like
I love doing that
like,
too.
it's like, oh,
I go to like the old like art house theaters in New York
it's just the
myself. Best. I know, and those are like what people have in mind, right? But I encourage people. I did this recently. I went to like a new IMAX auditorium, and it's just a complete experience. Like it just
the Cinépolis over here. I was joking, but like I saw the last movie I saw was F1. I saw that, and it was just
it's crazy, right? Like the curvature on the screen, seats are comfortable. The concession offering has improved substantially, right? Like you can drink alcohol now in the seats. Some of them even have like in-seat service, right? So
I mean, I'm still a popcorn and peanut M&M dude, but like, like all that and everything.
The experience. The operators have, they put a lot of effort into updating the offering because they had to.
Yeah.
And in many ways, they still remain kind of desperate to do so. So like, there's another nice component to it is like they're marketing it for you because they really want people. Right, like the economics, I think is something like, okay, let's say it's an extra $8, and like generally the studio takes like 50% of the ticket sale, right? So the studio gets an extra $4, and then like D-Box will get, I don't know, some percentage of the rest of that split with the operator who will get more, right? So maybe D-Box takes like 10% of that uplift. So everyone is making more money by doing this. And I think what you're finding when you can see it in the numbers of the operators is like people are willing to pay that premium for the experience. Mm-hmm. So, yeah.
Have you spoken? You talked to new management, yeah?
I've spoken to the CFO, yeah. Not the CEO, but as you kind of noted at the beginning of the call, like there's a lot of investors that are in this name, right? So I've sort of like outsourced a lot of my dialogue to friends of mine who are also investing in the company, right? So I'm sort of getting hearsay, but
okay, fair enough. Because my next question was going to be kind of along those lines of like, they're in an interesting place where it's like you want to keep pushing growth, but you're also, you want to be mindful of, who all the various potential partners are and where they're at in their life cycles, with the AMCs and the Regals and what's going on.
This is why the financial thing gets a little sticky, right? Because it's like, okay, maybe you could do some sort of like seller financing for the shares, right? And you basically say like, we'll pre-fund you like a bunch of the CapEx, and then like we're gonna take like a larger piece of the royalty until you pay us back, something, right? There's ways you could structure it, but to be careful because like some of these operators could just go bust, right? So you kind of have credit risk. But D-Box is in an enviable position because they don't have any debt and they're generating tons of cash. And the partnerships they already have, right? Like there's still quite a lot of white space with Cinemark, who's like very clearly motivated to roll these out. So I don't think, and then you have the potential pricing uplift, and then what I do think will be like some moderate growth in box office receipts generally. So you don't need to push for your growth. And the growth is, this is an asset-light business, right? It's like you have, 30% margin on the hardware sale, right? Or on the installation. There's also like some fee for projection room, like a fixed fee. It's like $20,000, something like that. And then everything else is like 100% incremental margin royalty revenue. So there's no need for desperation, right? Like if they stopped growing today, I think you'd be paying a fair price, right? You're kind of at like, you're at like, a high single digit earnings yield, asset light business, you'll be okay, right? So they don't need to grow that much. But I think it's really punitive to assume that they won't, right? Like I'm gonna really know like John at Sower Peak who had that like long research report on this, and he did some like really crazy research, but just going through it now, like
John gets out there, dude.
I mean, it's unbelievable the amount, right? But he's sort of saying, like, he kind of gets into like the white space. He basically he thinks like at Cinemark alone, there's like another 100 theaters that they could install, another 100 screens that they could install, right? So it's like that gets you like another, I don't know, like a set like like 7/10 of a cent of earnings, something like that, right? So even with the existing partner there, you have a huge amount of opportunity, and then it's like it goes into like the kind of like total screen count across just the U.S., right? And it's like you have, I think you've got AMC and Regal by far the biggest, and you have Cinemark, Cineplex, which we have. You have Marcus and all these smaller operators, but they have hundreds of screens, right? Like they're not tiny. They all have hundreds of screens. So there is, even just from like, one or like securing partnerships with one or two of them, like the growth could be like significantly meaningful from here.
Interesting.
And that's just the US.
Super interesting. I had one other question. I mean, do we want to touch on like theatrical windows as a potential thing that they're thinking about, or is that?
Yeah,
I'm sure they've had many conversations about it, but I'm curious.
It might be worth just talking about the Netflix like overhang in the industry, because just for like some sort of context for people that are not following, but like Netflix has made a deal to acquire Warner Brothers, which is like a huge, a huge distributor of films, and like there's fears that Netflix will, if they don't just altogether like not release movies for theatrical, will like shorten the windows materially, right? So you'll have like 2 weeks in the box office, and then it's to streaming. Sort of I think, I don't know, I'm not an antitrust expert, but like I have spent some time on it and been burned by this kind of stuff before. I don't think Netflix is going to get the deal done, and now we know there's like a hostile element with Paramount, who I think would clearly be a better owner for box office purposes. So I think it's very unlikely Netflix gets the deal done, but even if they do, there's incentive for Netflix to have theatrical releases, right? And you can see this in like, for example, they have an exclusive agreement with Greta Gerwig, who's a great filmmaker. She's releasing Narnia next year, and they have an exclusive agreement with IMAX. So it's like Netflix is a studio, IMAX is getting the entire window. No one else get, right? So that caused some controversy. You can see right there, like they want to advertise their films in theater. Amazon, who has like their studio business, is like pretty committed to theatrical releases. So I think you have to assume a lot of bad things for the Netflix issue to like actually hamper this quite a bit. It's fun. I'd be a little bit more worried about like, to the extent Netflix is a big problem, it's actually the operators, because the operators are, again, it's big operating leverage. So, at a certain point, you get tons of upside, very high incremental margins. Below a certain point, you're losing money, right? So incremental ticket sales are a really, really big deal for the operators. So if Netflix even starts taking a bit of that, that can be a problem. I worry less about D-Box again, because the white space is just so big. So even if like even if like the box office, total box office receipts like shrink by 10% or something, a D-Box will be fine, because they have like a tiny fraction of the total market right now.
For sure. I mean, just gaming it out. I was even thinking of Netflix, going on that point, even if they won, I feel like that will drive more creators and creatives to Paramount because if they
Yeah.
feel that it's really all driven by them, right?
Yeah, I mean,
Like
certainly some people, right? Because there's like some of the big auteurs, like Nolan, like a bunch of these guys came out against the deal right away. They're like, "This is terrible for the industry." Like,
James Cameron, he on the town. I'm sure you
right?
heard
Like,
that. Like,
it's
yeah,
like the filmmakers who are generating the big box office draws are already big fans of theatrical, right? So they're gonna like try to get their films in theaters, like James Cameron, Nolan, etc. Right? So I don't know. I think there's a real like shoot first, ask questions later kind of like thing in markets generally, right? Like people absolutely panicked on the Netflix deal. Interestingly, D-Box, I think it's because actually John released his research report on the same day. D-Box was up pretty significantly,
nice.
notwithstanding the rest of the sector kind of getting hammered. But IMAX has fully recovered its drawdown since that deal was announced. So I don't know. I think there's uncertainty, but I don't really think it poses like a huge risk.
For sure. All right, dude. I think we covered a lot here today regarding the thesis. I think we do a good job at least covering the
I
bear
think so.
side as
Yeah,
well.
kind of think
I
so.
want to be balanced. We don't want to just,
Me too. And I'm trying to, I posted something on Twitter like last week, being like, please give me your biggest bear case because, like, obviously, there's psychologically, I think sometimes there's a lot going on psychologically when you have a winner, right? Like one is
of
like, okay,
course.
like, not so much, like should I just take my profits or whatever? But like you can obviously like the real excess returns in investing come from just letting your winners really ride, right? But the bigger they get and the more money you've made on them, you really start to be like, okay, like I got to check myself here because maybe I'm too excited about this business now, and obviously you stand to lose more money, but kind of try to frame it from fundamentals, right? And despite this like major re-rating in the stock price, if you just kind of like if you just look at it from first principles and think like where are we today and where's this going, like I think it's cheap, right? I don't want to like anchor to the fact that this was a 20-cent share 8 months ago,
Hmm.
because like the margins went from like negative to like in the 20s, right? So 20 cents a share and they're going to do like 6 cents in EPS. So it was like 3 times earnings. Like that's obviously ridiculous. So the fact that it's re-rated to where it is today, I don't really. I think this is like still a value stock, right? It's not deep value, but it's like a quality tech company. Um, the other thing I'll say is I think it's a Canadian company, and that means some things. One is it partially explains the lack of discovery, right, and why like this was trading so low for a while because like it's sort of like an orphaned microcap on the Toronto stock. It's not a venture stock; it's Toronto Stock Exchange, but like orphaned penny stock, like no sell side coverage. I think you'll get there's this sort of weird thing that goes on in the industry, but like some people like institutional capitals, like, we don't like buy things that are below $1, right? So like kind of getting close to it, kind of getting close to the story being like more marketable from like an institutional perspective. Like I kind of probably think you see like sell side stuff, um, as we kind of like crawl through one. And I think the all time high was like $1.02 like a couple days ago, something like that. So we're getting there. The other thing is capital allocation, right? Because you have it's a very asset light model. If you kind of strip out the cash, and like intangibles, like tax asset, they have actually like a pretty meaningful like NOL as well. So like they're not really paying cash taxes for a bit. Kind of strip all that stuff out. They're earning very, very high returns on capital. So the kind of question is like, look, as they start to build cash, which they're going to be doing now, like what do they do with that money? And obviously, okay, you can like try to reinvest it and try to figure out how to like grow the technology into other like end markets. right? And it always comes with some risk, but like sort of given the pretty serious alignment with insiders and what they've done to date, I don't worry too much about them doing something like over aggressive. But like absent that, it's like, okay, maybe there's a capital return story here. And I do think like the math can get pretty crazy, like if they were to do share repurchases. But then also like if it becomes a dividend payer, like this brings me back to the Canada thing. Like Canadian investors are like they like yield more than Americans, right? It's kind of like more like a European mindset. Like you might get this priced on like a dividend yield. So there's some kind of like I want to say like technical things going on, but like there's ways that the capital markets maybe start to open up a little bit more to this story as it re-rates, right? Like, it went from like a whatever $40 million Canadian market cap, which is like totally uninvestable for many people, to something that's like more than 200 million now. So I think you're kind of opening up the story to a lot more channels. So that's another thing that might help with the re-rating, right? Because businesses with this economic profile, asset light, like important technology within like a broader ecosystem, very high returns on capital, et cetera, like kind of warrant a high multiple, right? So you don't need to underwrite multiple expansion here. But I think if the story continues to track like over the next couple quarters, I think you will get multiple expansion, right? So I don't think it would be crazy to see people paying more than 20 times earnings for this.
All right, Dylan, I think this is a good place to end it. We covered a lot. I'm sure we'll do another update at some point, but
100%.
For more information, to people get in touch with you, if they have more questions about your thesis, whatnot, where can folks go?
Yeah, just find me on Twitter. It's Raging Bull Cap, and my DMs are open, so people can message me whenever they want.
Hell yeah! All right, well, Dylan, thank you so much for joining me today, man.
Cool.
Really do
Thank
appreciate it, and have a happy New Year, and I'll see you soon.
You as well, my friend. Thank you.
Thanks, man.